Okay, guys, so the Apple financial model now contains our financial statement shells, our revenues, cost of goods sold, operating expenditure, and we now need to include working capital in the model. And working capital basically refers to the fact that not all revenue and expenses is received and paid in cash at any point in time. So, simplistically, most financial models, working capital includes accounts receivable, accounts payable, or debtors and creditors, and inventory. Now, if you look at why working capital actually exists, it sort of exists because of the accruals method of accounting, where accruals method of accounting sort of sits in and says, okay, well, you need to basically record your revenue when you earn it. So if you send out an invoice to somebody and they haven't paid at the end of the year, you might book that revenue in the period because that's when you earned the right to that revenue. But if it wasn't paid, it sits there at the end. So let's assume you shot out one revenue at the end of the year, one invoice at the end of the year for $1 million. It wasn't paid. You'd book revenue for that year $1 million if you were doing accruals accounting, which most larger businesses do. But then at the end of the year, you'd have no cash. So you'd have an accounts receivable sitting there or a debtor sitting there of $1 million. But the actual income would come through in the period in which you shot the invoice out. So working capital is really important to model properly because a business could be extraordinarily profitable and still become insolvent if it doesn't manage its working capital properly. So if it just doesn't collect its invoices and then pays all its bills really fast. So when we're modeling working capital in a financial model, the key is you want to actually relate your working capital forecast to your revenues and expense forecasts so that when you change your working capital assumptions and your revenue assumptions, everything sort of flows through. So when you double your revenue, your accounts receivable should go up unless you're changing your rate at which you're receiving your invoices that you're being paid. Now, the most common approach to modeling working capital is what's called a days approach. And a days approach is where you basically use the number of days it takes to receive invoices or make payments as a proxy for sort of calculating what your actual forecast closing balances are. So here's a simple example. There's one in here. So say you send out $1,000 worth of invoices during the year, but only 900 of those are paid in cash during that period. That means that at the end of the year, you'll have accounts receivable of 100. And of that 100, you'll say, well, there were 365 days in the year. So 36.5 days outstanding. Another way I always look at it is saying, imagine you shot out one invoice for $1 every day and everybody paid them consistently the exact same distance away. If at the end of the year you had 10 outstanding, that would be 10 days payable. So it's kind of weird. The graph I'm showing you here simplistically shows, it assumes the days approach assumes you're consistently sending out invoices or receiving bills and you're consistently paying them. But that's why in a more complex model, you have different levels of debtor days for different types of products and services. The important thing is that you relate your receivables and payables to your actual revenues and expenses. Okay, and that's where what's called the debtor days and creditor days come in. Okay, so if you look at the calculation of the days for debtors, inventory, and creditors, I'm going to be using the term debtors throughout this course. In the US, most people refer to accounts receivable. Creditors, accounts payable, same thing. But when you look at the days, debtor days is literally the closing debtors balance, like we said, divided by the revenue during the period, multiplied by the days in the period. So if your revenue we said was 1,000, your closing balance so your closing debtors was 100. Yep. You'd have 100 divided by 1,000, it's 0.1 multiplied by days in period. If it was a year, say 365 or 366, which you need to always be aware of, you have 36.5 days. Okay. So let's do this now by looking at debtors. Now, in the model at the moment, we assumed revenue equals cash. So we've got our profit and our cash flow statement impact of revenue are identical. So I think for Apple during the period, I don't know, what did we have in there? What was our forecast revenue? So, I mean, you look at for FY 2020 for Apple, they had 274 billion of revenues. FY 20 was 366 days, implies an average debtor days of 21.5 days on their revenue, which is the 16,120 because their receivables net on their balance sheet was 16,120, which is a current asset, and their total revenue is 274, and the 366 days is 16 of receivables divided by the revenue multiplied by that is 21.5 days. That's a decrease from FY19 closing balance of 22. They went from 22 down. Now that's sort of pandemic related stuff. They actually, I think, overstocked. They had bad inventory management during 19, and that was a real issue for the firm, for the company. Along came the pandemic. Everyone has heaps of money, buy stuff.
Perfect.
So amazingly. But that resulted in their days moving a lot. So their debtor days, average debtor days for FY20 was 21.5, FY19 was 32.2. Okay, so now note that Apple also has vendor trade, non-trade receivables within its current assets. We're just going to ignore those. If you're modeling this properly, you'd probably have a separate category for those, and you'd actually look at the driver behind those now non-trade receivables basically is them selling components is basically them selling components to manufacturing vendors that then go and make their parts, and they take time to pay them for those parts. That's pretty tricky stuff. So you need to dig down, you need to deep dive into their financials to understand exactly what is driving that. We're just going to keep it simple. We're going to model accounts receivable net, which is third-party receivables to like customers and distributors. Okay, so if you go into our financial model and go to the opening balance sheet, you'll see that debtors is a current asset. It's a current asset because obviously it's almost always accounts receivable within a year. Mm-hmm. So let's put in 16,120, which is the debtors balance of accounts receivable net closing balance for the FY20 for Apple, and you'll see the balance sheet straight away disbalances. The balance sheet is disbalanced because we now have an opening balance in the balance sheet, which is obviously through our retained profits plug has changed our retained profits number down the bottom, but we're still forecasting. We're not forecasting that anywhere. No. So we need to forecast the debtors closing balances. Now to do that, as I said, we need to relate our debtors closing balance to our forecast revenues. So we're going to use the days approach for all of these three types of working capital for debtors, inventory, and creditors. Now for debtors days, we're forecasting 25 days, which is basically somewhere in between, the 32 days and the 21 days they had in 19 and 20. So we're just going to forecast 25 days, and we're just going to apply it to total revenues. In a more complex business, you'd have debtors by product, that type of stuff, and it might be different for services and for products, etc. Same concept, just more complexity. So if you look on assumed revenue, we've based on assumed revenue of 289,613 in FY21. If we look at 25 days, that means our forecast closing debtors balance for FY21 is 19,837, which is the revenue of 289,613, multiplied by the 25 days divided by the 365 days in 2021, which is a $3,717 million increase from the opening balance sheet debtors of 16. So we're going from 16,120 to 19,837. Now, if you look at the financial statement impacts of this, because we've already modelled the revenue, right? If you just look at the debtors impact, it's an adjustment to cash. Yep. So what it's saying is, oh, hold on, my debtors, my debtors actually went up by 3.7 billion, which means I've put revenue in, which hasn't actually been received. I need to make an adjustment to cash to make sure that my actual cash wasn't what I said it would be because the revenue isn't cash. So if you combine the financial statement impacts of revenue in blue with debtors in green, you see that we reported revenues of 289. Of that, there's the 3717 here. 3717 we're adjusting for, saying our actual cash was 285 of the 289. So our cash increases by the 285. Our debtors increases by the 3.7. And we end up with our net assets still being the entire amount because that's what we earned. But the constitution of our assets is now different. Yep. We now have cash and debtors as opposed to cash. And the reason why it's important to split out debtors is because debtors is riskier than cash. Cash is king. Debtors you may not get. Could be bad debts. So it changes the constitution of your balance sheet, the risk profile of your balance sheet. So in this basis, your net assets now are still the same as it was just with revenue, but you can now see, some of that's actually debtors, which in a really crappy business, you'd have huge debtors and little cash. You'd be like, these guys are out of control. They could be insolvent. And that's where businesses, highly profitable businesses, can become insolvent through not managing their working capital properly. So let's include this in the model. So the important thing to bear in mind is that the working capital does not impact the income statement. It doesn't affect profitability when you're using accruals accounting in your income statement. So what we're going to do here is we're going to put a balance sheet item onto the balance sheet, which is going to be our debtors, and we're going to put a cash adjustment through the cash flow statement. And we refer to working capital adjustments to the cash flow statement as working capital adjustments. So what we're now going to include in the model is debtors, and we're going to include the debtors working capital adjustment. Now, the first thing we're going to do is we're going to go into the balance sheet. And we are going to, I'll just note one other thing if you look at my screen. Note that we've put in there decrease in debtors, the terminology. The reason why we've done that is because it gets really confusing as to whether an increase or a decrease in a working capital account increases or decreases is a positive or negative cash adjustment. Yep. Now, the way you want to view that is an increase in your debtors means that you basically at the end of the year weren't paid. So it's a decrease in cash. So on the balance sheet, on the cash flow statement where you're reporting cash receipts, and an increase in cash is a positive number, that means that a decrease in debtors is a positive number. Because your debtors went down, it means you got paid. You got cash in the door. Yeah, so when you use increase and decrease on the cash flow statement, you do that basically saying that that a decrease in debtors is an increase in cash. In this case, we've got an increase in debtors, which an increase in debtors is therefore a decrease in cash. Yep. So it's weird. An increase in debtors is a decrease is a decrease in an increase. It's kind of confusing.
Yep. So we use decrease definitively so that the positive number we know is a decrease. And then if it's a negative decrease, you know it's an increase in
Exactly.
in
And that's the way you need to look at it. So if you look in this case, if you looked at your balance sheet for FY 20 to 21, then you know here if the decrease in debtors is negative, it's actually increased.
Yep.
It's kind of confusing. This used to get me. When I first started in banking, this used to destroy me. A number of times I get the sign wrong when doing working capital, but that's why we use that. Okay, so let's go to our balance sheet. Now, debtors is a current asset in the balance sheet. It's accounts receivable. It's due within 1 year, and we're going to forecast it by basing it on our forecast total revenue and applying our debtors days assumption to that of 25. So let's go into row 15 and just put debtors in column B. So B15 is the heading, and then for the formula, we are going to multiply the total revenue by the debtors days assumption and then divide it by the number of days in the period. Now, in this case, we don't have days in period broken out as a period title row. You might sometimes do that in models. It's sort of 6 to 1, half dozen of the other. We're only going to use them in this course for working capital, so it's probably not worth adding an extra row at the top. So the formula is going to be the total revenue, so equals income statement J12, which is equals total revenue, multiplied by our debtor days assumption of 25 days.
On the forecast sheet.
Forecast sheet multiplied by the days of 25. Okay, and then divided by, and when we divide by, we're going to do open brackets, and we're going to calculate the number of days in the period by subtracting the period start date from the period end date and adding 1. So on the balance sheet, go up and do equals $6. You're going to have that issue again with the annoying.
I'll get rid of these BS exclamation mark. So less
$6 minus $5.
Wait. And plus 1.
And then end that, and that should give you 137. That should give you 19,837.
Perfect.
Okay. So if you copy that across, and then just include in total current assets that formula by changing the formula to include cash and debtors.
So it'll be a sum of these two.
Yeah, just to equal sum. J12 to J13.
Perfect.
Is that right? J12, J14 to J15.
14 and 15.
J14 and 15.
Yep.
Cool. And you'll see when you do that. We then end up with the balance sheet not balancing. So we've now got the debtors included in the balance sheet, off the opening balance sheet coming through. Not off the opening balance sheet. We've got the forecast debtors balance included there, but we don't have the movement. So now we need to put the movement in the balance sheet, the working capital adjustment through. Now the movement in the first period, if you go to the cash flow statement, the movement in the first period, which is going to be the 3717, which is from the opening balance sheet figure through till that closing 19,837. So we're going to have to do the first period based on the opening balance sheet. So what this calculation needs to do to calculate the movement, and because we put decrease in debtors, you basically want to take the prior period, then you want to subtract the current period. Now the prior period in the first period is the opening balance sheet. And then after that, it's the prior cell on the sheet. So we need to use an if statement to make this work. So go to row 13 on the cash flow statement. Again, we're starting in C. It's a detail row. Type decrease in debtors. And first of all, what we want to do is we want to take the prior period debtors. Now, so to do that, just do equals if. Actually, you're going to have to open your period titles. So open rows 5 to 8. So expand those.
Yep.
And then do, in cell J13, do equals J$7 equals 1. So the period number equals 1. Then, go to your opening balance sheet and grab that number there, which is your 16 billion.
I'll lock it to the column.
So dollars J17. Otherwise, you want to take the prior period on the balance sheet. So go to the balance sheet and do I15. So the period before the current period.
Yes.
Now, obviously, in the first period, it's going to ignore that empty cell. But as it moves across, it's going to take the prior cell, and that's the important thing. So then you close that bracket, and that's going to give you the prior period. And then you need to subtract the current period. So do subtract, and then balance sheet J15, which is the current period.
Balance sheet
J15. So press enter, and that should give you your 3717. So that decrease, that increase in debtors of 3717.
Yep.
Is a negative cash adjustment because it's a negative decrease.
Yes.
So it's an increase. It's a double negative.
Okay, so an increase is a negative decrease.
So an increase in debtors would be a decrease in debtors would be an increase in cash. But this is actually an increase in debtors, so it's a decrease in cash.
Yep.
Okay, it's confusing, but you have to get your head around that. It's a negative cash adjustment because debtors has increased, which means you've reported revenue on your income statement which you haven't received as cash. So if you then put your cash receipts, adjust your cash receipts formula, so it equals J12 to J13. So cash receipts is now the net of your revenue and your decrease in debtors.
Perfect.
Your balance sheet balances again. The important thing is you're now reflecting the fact that you only received 285 billion. Only 285 billion. You didn't receive the full 289 because your debtors went up. Okay, and that's the important way of that's the important thing to capture with the working capital adjustments.
Mm-hmm.
This will also now make sure that when you change your revenue forecast, that 25 days will flow through, and your cash flow adjustment will also adjust. So if you doubled your revenue forecast, your closing debtors balance would also double, and that means your cash would adjust accordingly. So you wouldn't be forecasting revenue increasing by this without any cash flow impact, with the cash flow impact being all revenue.
Yep.
Okay.
So it's all interrelated.
It's all interrelated. Okay, so let's group those rows. Let's group rows 12 and 13.
Cool.
And just select those and group them. And then we can group them up, and our cash flow statement's slowly coming to life, and there's our cash receipts. Okay, so our model now contains our financial statement shells, our revenues, expenses, COGS. We now contain debtors. We need to allow now for adjustments to inventory and to creditors. Okay, so inventory. Now, inventory is one of those things where you can model it simply, very easily. Modeling it really properly is often for some businesses extraordinarily hard. So you think about inventory. The problem you have with inventory in real life is you buy inventory constantly. You then buy it at different prices, and you have to choose whether you have last in, first out, like FIFO, LIFO, and then you sell it, and you then have to actually allocate your cost of goods sold when you sell it to which inventory you actually purchased. And then you have different lags on purchasing inventory. You also have invoices for inventory received, which means you have creditors relating to your inventory. So inventory modeling it properly via effectively a balance sheet approach, where you're buying inventory, then writing it off through the cash flow for the income statement, is really complicated. Most financial models don't bother doing that unless you're a really complex inventory manufacturing business. Most companies forecast their revenues, then they forecast their COGS based on their revenues, like we did, but often with a margin. And then we forecast inventory based on effectively an inventory days number being applied to our COGS. So basically saying, okay, let's assume that we had to buy our inventory a number of days before we expensed it. And basically saying, you obviously, that's realistic. You normally have inventory sitting there. So a badly run company might have inventory sitting there for 6 months. A well-run company might have it sitting there for a few days. Okay, so if you look at inventory days, you need to look at basically, if you look at Apple, for example. So Apple, for example, their inventories are on their balance sheet here as, say, 4106 in 2019, going to 4061 in 2020. This basically relates to their cost of goods sold. Now, remember the cost of goods sold, we stripped out D&A. So for FY20, their closing inventory balance was 4061. Now, the cost of goods sold excluding D&A was 158, which is in our model. So if you go to our income statement, our cost of goods sold for FY20. That's FY20. So hold on. So for FY20, we stripped out the D&A to get to 158. If you then calculate inventory days, you take the inventory of 4061 at the end of the year for FY20, divide it by their cost of goods sold excluding D&A of 158, multiply it by the 366 days because it was a leap year, and you get inventory days for 2020 of 9.4 days. If you do the same approach for 2019, you get the 4106. I thought this was hilariously confusing. 4106 and 4061. Yeah, it is. You get the 4106 for 2019, which based on total cost of goods sold excluding D&A of 149,235 for 2019 is about 10 days. Okay, now Apple's they're either heroic with their inventory management, or we've simplified it down to the point where it's not quite accurate. That being said, as long as our forecasting approach is consistent with the data we're deriving from our historicals, it's still a safe way of forecasting. It just might not be huge. It's a real simplification, but it will still work. And that's what we've got in the materials. We talk now about the fact that this is a great simplification of reality, but the key is relating your COGS to your revenue and your inventory to your COGS, which is what the days approach does with inventory days. Okay, so let's go to our Apple financial model, and let's go in and put in our financial year, our FY20 closing balance of inventory of 4061 into the inventory assumption in J8.
4061, cool.
4061, our balance sheet again doesn't balance. Now, if you go to our forecast assumptions, you'll see we've got inventory days forecast. We've just put 9 in. It seemed like a reasonable. It's basically inventory days we're putting sort of in between the last 2 years of 9 and 10. So we've just put 9 in, keep it simple. So assuming cost of goods sold of 166,817 for 2000, which I think if you go to our income statement, I think we have 166,817 for 2020.
Correct.
Yep, for 2021, 9 inventory days. Apple's forecast closing inventory balance will be 4113, which is the 166,817 multiplied by 9 divided by 365. Now that's a $52 million increase from the 4061. Now an increase in inventory is going to be a decrease in cash.
Yep.
Okay, so if you look at this financial statement impacts, that basically means you've bought stuff you haven't sold. Okay, which is a source of pain for most manufacturing businesses. So in this case, we've got our inventory increasing by 52 on the balance sheet, and that's a working capital adjustment of negative 52 because it means the COGS we've put through hasn't all been bought. As basically it doesn't reflect the cash position. Okay, so our inventory is increased, we haven't sold it, so we're going to decrease that. Okay, so if you look at this, the inventory movements with both COGS and inventory, you end up having your COGS here. So what this means is you bought more inventory than you sold. So you sold 166,817. Your inventory went up by 52. So in actual fact, your total purchases with this simplistic approach were 166,870, which is higher than what your earnings impact is, because some of it hasn't actually been sold yet. The inventory, it's sitting on your balance sheet at the end of the period. Okay, so this results in, when you look at it this way, you end up with your change in cash held being 166,870. Your NPAT was 166,817, which you actually spent more than you expensed. Okay, so if you look at this, you look at how we then report that on the cash flow statement, you'll see we report that as a decreased inventory because a decrease in inventory is an increase in cash. A decrease in inventory, the way I think about it, is you selling product. So you want inventory. In a perfect world, you wouldn't have inventory. You'd buy something and sell it instantaneously. The world would be a great place. Inventory is dead assets. They are a disaster. They might go off. They might not be sold, in which case you write them down and sell them. So ultimately, a decreased inventory is an increase in cash. You want your inventory to decrease. So let's go into our balance sheet and put this in, right? So let's go to the balance sheet and go to row 16. Again, it's a current asset because inventory is expected you'll sell it. It's an asset you'll sell in the current reporting year.
Yep.
Okay, so let's put inventory as the heading, which you've done. And then very similar approach to what we did. In this time, instead of using revenue and applying it debtors days, we're going to use cost of goods sold and apply an inventory days. Now, because cost of goods sold is negative on the income statement, we need to start off by negating that. So do equals negative cost of goods sold in the income statement. So equals negative IS J13.
Yep.
Okay, then multiplied by our inventory days assumption, which is forecast J19, which is the 9.
Days.
And then again, then we need to divide by the number of days again, okay? So we need to divide by the brackets, and we do sort of last end of period. So J$6 minus J$5 plus 1.
Plus 1.
Get rid of those annoying sheet references. So 6 plus 1.
So we got 4113.
4113, right? Which is an increase of, I think that's an increase of 52 from our opening balance sheet.
Awesome.
Okay, so let's just make sure we include inventory and total current assets. So change the total current assets formula in J18 to be equal sum J14 to J16. Okay, copy that across. Again, balance sheet's not balancing still because we haven't incorporated the cash adjustment for that.
Yes.
So we have an asset being added. The movements in that aren't flowing through the cash flow statement, so we're off. So total current assets should now be 137,660. Total current assets, yep. And decrease to 467,851 in 2025.
Yeah, 467,815 increasing up. Perfect.
Yeah, perfect. Increasing up.
So now over to the cash flow.
So now we need to do the cash flow. So to add the cash adjustment, we've got, if you look at our opening balance sheet, what's our opening balance sheet inventory?
Opening balance sheet is 4061.
4061. If you go to our balance sheet in the first period,
what do we have?
Excuse me, go to the balance sheet, we've got 41. So that's that increase we need to get through, okay, which is the increase in inventory of 52 is going to come through as a negative cash adjustment. Okay, so let's go to the cash flow statement. And what we want to do now is let's add now the decrease in inventory. So go to row 17 and in cell C17 put decrease in inventory.
Perfect.
Decrease in inventory. Exactly the same. Now decrease, because the last one was a decrease in debtors.
Yep.
This is a decrease in inventory. So you'll see that decreases in assets are an increase in cash.
Yes.
That's the way to think about it. So it's the same formula as last time. So we need to go into J17 and put if the period number equals 1. So if J$7 equals 1.
Equals 1.
Then we need the opening balance sheet balance.
That 4061, and again lock it to the column.
Exactly, 4061. Otherwise, so comma.
Yep. Go to the balance sheet.
The balance sheet, the prior period on the balance sheet. So I16.
Yep.
right? And then close that bracket. That's your prior period. Then you subtract the current period. So minus balance sheet J16 current period.
Perfect. So
And there's your negative 52.
52.
So that is an increase in your inventory, which because an increase in inventory so we've got decrease in inventory is an increase in cash. There's an increase in inventory, so it's a decrease in cash.
Yep.
This is fiddly stuff. I remember when I started modelling back in investment banking, I'd always get these signs wrong.
Mm-hmm.
So that's why we started writing increase and decrease. So if you include those in cash payments, just do equals sum J15 to J17, copy that across, your balance sheet comes back to life, and now you have cash payments of 210,254 in 21, increasing to 275,692 in FY25.
Perfect.
And your balance sheet balances. And it balances now because obviously the movement in inventory in the balance sheet is offset by corresponding cash adjustments in the cash flow statement, which flows through to net assets via cash. Okay. So that's it. So you'll notice they're very, very similar. In both cases, both revenue with debtors and cost of goods sold with inventory, we approximated and related the closing balances of their working capital assets to the revenues and expenses on the income statement. We're going to do exactly the same for creditors. Now, creditors, otherwise known as accounts payable, is identical to debtors or accounts receivable, but for the fact that it's a liability because it's you owing invoices to third parties rather than you waiting on invoices being paid from third parties. So it's the same approach. Instead of saying debtor days, we say creditor days. And the only difference is instead of it being based on revenue, it's a liability based on an expense that you've incurred. Okay, now for Apple's interesting because the majority of their actual expenses are COGS, and we haven't modeled inventory payables, which you could do in a more complex model. You'd model inventory payables. In fact, I think our more complex example at the end does that. But to do it more simplistically, you would just base your creditors, which is your accounts payable, on both your COGS and your operating expenditure. So if you look at FY20 for Apple, their closing creditors balance was 42. So you'll see their creditors balance is down under accounts payable. And the current liabilities part of their balance sheet. Their closing balance was 42,296. That 42,296, based on total cost of goods sold and operating expenditure of 197,171. Now that's the cost of goods sold of 158,503 and operating expenditure of 38,668. Now you'll see there we've actually taken out the depreciation and amortization from that.
Yep.
And that's the important thing to bear in mind. So that 158 number is net of D&A, which we removed. It's consistent with the model. That's important because otherwise we'd be forecasting on a different basis than we're historically analysing. So based on COGS net of D&A of 158,503 and OPEX of 38,668 and 366 days in 2020, we had 78.5 days, which is the 42,296 closing balance divided by the total of 197 times 366. Now in 2019, applying the same analysis gets you to 91.9 days, which I think actually is the case. I think they had some inventory issues because things didn't sell well as they expected, and the iPhone didn't sell as well as they expected in FY19. So they got stuck carrying. They got stuck carrying stuff, and they got stuck with both inventory and creditors in that year. So it's because of the COGS inventory that we're getting hammered there. So as a result, we're going to apply that same approach. So let's go into the model and go to the opening balance sheet. And you'll see creditors, this is all very similar to debtors. It's just different terminology and based on expenses, not revenue. So let's go to our opening balance sheet and go to row 18 and just put in our creditors of 42,296.
Done.
And you should now have, and that should be your entire, so we should have total assets. Just make sure we're still on track here, 58,197. Yep, we're in good shape. So you'll see the balance sheet's now disbalanced. So you just go back to our forecast. We've got creditors. We're putting in 80 days, which is basically in between the last 2 years of analysis where we had the sort of 91 days and the 78 days. We're just going to put 80 days. So we've just put 80 days. So that means, for example, based on forecast cost of goods sold, if you go to the income statement, our cost of goods sold is 166,817, an operating expenditure of 43,385. Now, with our 80 creditor days assumption, that means the closing balance we're going to forecast for FY21 is going to be 46,072, which is the 166,817 plus the 43,385 multiplied by 80 days divided by 365 days in 21. Okay, so that's a 3,776 increase from the opening balance of 42,296. So we're going to go from 42,296 to 46,072. So that increase is the adjustment we need to put through. So if you look at my screen, we've got the 3,776 increase. Because our creditors increased, it's like we basically put expenses through the cash flow with the income statement, but we didn't actually pay them.
Yep.
So we had 3.7 billion of unpaid expenses, which as I said, probably relates to our COGS with Apple. But we need to put that through. So we've got an increase in creditors of 3776. That needs to go through the cash flow statement as a positive cash adjustment because it's money we didn't actually end up spending that we said we did on the income statement. So if you look at how that muddles together with COGS, OPEX, and creditors, we said on our income statement that we spent 210,202 total. In actual fact, we only spent 206 because we actually didn't pay bills of 3776 at the end of the year. So that means our total committed expense is still the 202, which is what our net assets can be impacted by. But we didn't spend all of that as cash, which is why the actual impact on cash is only the 206, and the remaining is a liability.
Yep.
So again, the net assets still reflect the earnings, but the constitution of the balance sheet shows we've actually still got some of that cash.
Yep.
We've got some of that cash at bank. We haven't spent it all yet. So you'll notice we have increasing creditors. I always think about this, especially in this day and age. An increase in creditors is an increase in cash. It's basically someone's basically either billed you for something you haven't paid them. You're like, I've still got that money. Or a good example of creditors at a bank where you borrow money, so it's cash. So increasing liabilities is always an increase in cash in most cases, and almost always when you're doing cash adjustments. So let's go and put this through the balance sheet. Okay, so go to the balance sheet and go to row 26 of the balance sheet, and let's put in B26, just put creditors, the first current liability, and then in this case it's different. So in this case, what we need to do is we need to actually take the closing balance. We need to actually take the negative of, because obviously the expenses will be negative on the income statement. We're going to take the total of COGS and OPEX, negate them, then multiply them by the creditor days assumption, then divide it by the number of days in the period. So the first thing we need to do is negate the sum of COGS and OPEX. So it equals negative, open brackets, and then go to the income statement and do COGS. So J13 plus J15. Close brackets. Multiply that by your forecast creditor days assumption, which is forecast J20 on the assumptions.
J20 creditor days.
Creditor days. And then divide that by, so / open bracket, divide by, and then the number of days in the period, which is your closing balance.
Again.
Closing date, end date minus your start date.
+1.
+1, and get rid of those horror, annoying.
It'd be great when Excel fixes that.
I think there's a good reason for it. I've just never quite worked it out. I think it's when you're doing there's some weird reasons for it, but anyway, let's not go there. So you should end up therefore with the closing balance of 46072 as expected.
Perfect. Yep.
Great. And let's put that through total current liabilities by adjusting current liabilities with equals J26, the only current liability we've got right now.
Got that in.
And our balance sheet's still not balanced. So we've now put our closing balance through the balance sheet, but we haven't got the cash adjustment. So the cash adjustment here, if we go to our cash flow statement, the cash flow statement is an increase in cash is from an increase in creditors. So in this case, let's go to row 18 and put in C18, increase in creditors.
Increase. So it's the opposite of inventory.
Exactly, because an increase in creditors is an increase in cash. It's basically bills we didn't pay. So it means you've put expenses through the income statement and said, we paid those, but actually, no, I didn't. So you adjust. Okay. So in this case, this is different. Increases are easier in my mind because you take the current period and subtract the prior period. So the current period is the current period on the balance sheet. The prior period is obviously in the first period going to be the opening balance sheet. So the formula here needs to be equals the balance sheet closing balance. So equals J26, closing creditors balance.
Closing creditors.
J26, and then minus, if open brackets, the period number. So you need to go back to the cash flow statement.
So go back to cash flow.
If the period number here, if J$7 equals 1.
Equals 1.
Then you need to go to the opening balance sheet and get it from there because that's your prior period in this instance.
Cool. Unlock that.
And lock that. So opening balance sheet $J18. Otherwise, so comma, the prior period on the balance sheet, which is balance sheet I26.
I26. Cool.
And close that off. Then press enter, and that should give you your 3776 closing balance.
That is the increase in cash.
Which is the increase in cash in this period, and then copy that across.
And update my sum formula.
And update your sum formula to include 15 to 18 in your cash payments and your balance sheet you're balancing again. So you'll see now that what that's done is we've adjusted our revenues for cash not received, and now we've adjusted our COGS and OPEX, and assuming COGS equals an expense like we talked about, because we've simplified that. We've treated COGS like operating expenditure, which is okay in a simple model. So we're basically our revenue we've adjusted for revenue not received in cash, and now our actual expenses, which is our COGS and OPEX, we've adjusted for both inventory and bills not paid, which is made quite significant adjustments of around $3.5 billion of an increase compared to what we see on the income statement, because we actually have creditors outstanding that have increased. And our balance sheet balances, because our working capital adjustments offset the movements in the assets, working capital, current assets and liabilities we've included in the balance sheet. So now our model now we just need to group those rows.
Perfect.
So just group those rows 15 to 18.
Group and hide them away.
Group and hide them away.
Perfect.
And our nice little cash flow statement's coming to life. So our model now contains our debtors, inventory and creditors, and they now reflect the working capital adjustments so that the cash receipts and cash payments now correctly reflect the timing of cash payments and don't assume that revenues and expenses equal cash paid. And we're ready to move on to fixed assets modelling.